Good morning, everyone, and good afternoon if you are in the East Coast. And thank you very much for joining on this Sunday. Today, we are going to talk about very interesting topic, estate planning. We left our country, India, and we settled down here. We are working so much day and night to build the wealth. But we are making that money, we are building our network, we are building our assets, we are building our estate. But with my experience, I have been seeing we are failing on planning. How do you transfer your assets to the next generation? The concept is very big, but today we are trying to start with one part. At somewhere we have to start with some basics. So today we are trying to cover some basics, and we would like to give one of the option which you should consider from the estate planning perspective. So today with me, our partner Sudhir Pai is also here, and I will introduce him as we move on. And I strongly believe that our community needs this planning. Otherwise, I am not very sure whether if you are familiar or not, there are federal taxes of 40% on the state taxes as the state taxes, federal, and also there are some state taxes. We'll go through in detail. I'm setting up the ground so that you can focus on the things. Yeah. And if you have during the session, if you have any questions, feel free to post your questions in Q&A. Definitely we will try to answer, or otherwise even you can schedule a meeting with us and we are happy to answer your questions there. I'm sharing my screen. From there we'll go. Sudhir, I hope you can see the screen, correct? Full screen.
Yes, I can, Anish.
So the power of estate planning and premium financing. So we are trying to cover these two topics today. So as I said, estate planning is very complex, but if we have a proper planning, what can be achieved is what our objective of this session today. And as usual, always our motto here is to keep the money what you earn with you, because the taxes are very high and few people are very successful in a few people are very successful in managing the tax planning, but some people are failing. So we're trying to bring the awareness here. And today, I'm just sharing my knowledge with my community. Sometimes it may be applicable, it might not be applicable. So we strongly recommend you to work with your financial advisor or CPA, or at least talk to me once before you implement any of these strategies. Most of you know me. If anyone is new, this is a very brief about me. My name is Anil Grandi. I'm the CEO of AZ Fintechs and also Grandi Fintech CPS INC. I have 20 years plus experience in the core tax, finance, and accounting fields. And I work for Amazon, Starbucks, PricewaterhouseCoopers, and also Sun Edison, which was the world's largest renewable energy company. And I was the finance controller there. And I have been serving as a Forbes Finance Council member. And I'm also awarded as a top 20 CEOs in the year 2022 in the finance field. And we are based out of Dallas as a corporate office, but we have the licenses to do the business in all 50 states of America, and we are serving in many states on tax planning, tax filing, accounting, CFO services, and we recently started India compliances. If you have businesses in India, if you are worried about compliances, about GST filing, transfer pricing audit, tax audits, this is a one-stop solution for all our clients. Everything can be handled with under the umbrella of AZ Fintechs. And we also got into the estate and financial planning. We are diversifying our portfolios to help clients better and trying to bring more value to our clients. And I have written a lot of articles. You can maybe later you can just do some Google search about me. You will understand my contribution and also what I share with the community. And recently, I addressed an ultra high net worth individuals exclusively on wealth building. How do you build your wealth? To one extent, you work so hard for the first million, you work so hard. But after that, how do you build your wealth? If one will become 2 million, two will become 4, 4 to 8, 8 to 16, like that, maybe hundreds of millions of dollars. What are the right strategies you should consider? And recently I addressed this as a chief guest. I recently addressed this exclusively ultra high net worth individuals. How do you build? How do you multiply your wealth? So, and even I am alone here. I am supported with a very big team of CPAs, finance professionals, and also chartered accountants. And we are around 80 employees right now, US and India together. Many people think they can do a lot of things on their own, but that is not the fact. If you try to do on your own, or if you try to build your wealth without any proper planning, you will not achieve more. But if you can do a proper planning with the right team, your success depends on with whom you work. It's very, very important. If you can do a proper planning, your wealth building can be much, much bigger. There is a lot can be done with a proactive planning. And you may be thinking, what planning is really required? Look at the successful business owners, successful millionaires, successful billionaires, Warren Buffett, Jeff Bezos, Elon Musk, Michael Bloomberg, and many more. How they are successful? They are successful because of the proactive tax planning, proactive estate planning, proactive financial planning. Without planning, if you try to do something post-mortem, the success rate is very low. You need to be lucky to be successful. But if you have a proper planning, the success percentage will be much high. The probability of success is very, very high. And even you save few thousands of dollars per year. If you can, with a proper planning, by the time of retirement, it could be helping you to build millions of dollars of wealth. This can be done only with the planning. No planning, no success will come. No, you cannot retain your success. So, and how do you know, are you working with the right team or not? Just imagine once, when was the last time your accountant or CPA, financial advisor came to you proactively and say that, come on, let's do some planning. In our life, 3 people are very important: attorneys, financial advisors, and accountants, and doctors. You can't compromise on these 3 people. Your success always driven by with whom you're surrounded by. So do the right choice. It's not about whether the friend or advisor is next to your home, next to your city, next to your hometown. No, doesn't matter. It doesn't matter where the person is living in America, as long as they're bringing the right value for your business, for your personal network building, and also for your personal things. So very, very important. You need to pick the right person who can help you. Let's get into our topic for today, estate planning. What is an estate plan? Estate planning is a process of determining the distribution of your assets upon your death. Everyone will die, and there is no guarantee that tomorrow morning we get up. It can happen to you, it can happen to me, it can happen to anyone. Do we have a proper plan in place? How do you transfer your assets? It is not easy. The assets will not be automatic. There is no automatic route here in America. So it is very important. So how do you plan in advance? And what you should know? You might have been hearing, if you are in America for quite some time, you might have been hearing will, trust, will, trust, will, trust. What is will? What is trust? So will is a document where you can write down how the assets can be transferred after your dismissal. So, but if you have the will, a lot of time I noticed people have will, but will is not enough, because if you have the will, probate is still required. It means you have to go after your dismissal. Your kids or your next generation has to go to the court and get the approval to get the assets from the court. It's called probate. It has to go through a court process to decide who will be your legal heirs. And also, there is no privacy for who is owning the asset. Or like right now, you may be having assets, but all your names are public. That means people can go online and see who is owning this asset. If something happens to you, people can file a case on you because they know that how wealthy you are. But if you have the trust, the assets can be under privacy. So the assets can be owned by a trust. Like example, I can have a trust with any random name. The random name of asset trust will own all my assets. So it is very difficult for you to go and find and identify assets which are owned by me. So that is where the trust helps. And trust can also help you to avoid probate. Something happens to you, your asset next moved on to the next generation. Your next generation doesn't need to go to the court process to get their assets. So, and there are a lot of other advantages are there in the trust when my partner Sudhir Pai will be covering those points in detail. Just I want to give, because as you know, I am a tax guy, I would like to focus more on taxes here. Like example, you have by the time of your dismissal, you may be think you may be at the age of 40 years or 50 years, but even as you know, even you leave the assets as it is. If you can do a proper planning with the rate of return of maybe around 10 plus rate of return every year, every couple of years or every 5 years, your assets will be double. By the time your disposal, 70 years or 80 years, that is when you need to look into what is the net worth of your assets. An example, by the age of 75 or 80 years, you will expire, and by the time your net worth might be $50 million. Right now, under year, like example, I will take today. Today, right now, your net worth is around $50 million. Right now, we have some tax exemptions of up to $27 million for you and your wife together, for your spouse together. On top of that, if you have any extra asset on top of this exempted asset, you need to pay 40% taxes to the federal government. And unfortunately, this exemption is also going down from the January 2026, which I'm going to cover in the next slides. So what I'm trying to say, even you made a lot of assets, even you think that you built some good wealth, there is no guarantee that all the wealth will be transferred to your next generation. Very important. Because 40%, it's not 5%, not 10%. 40% of your asset will be taxed as the estate taxes. So this is an IRS website. See this, what IRS website says. Clearly, right now, each individual can have an exemption of up to $13.6 million. Spouse, along with your spouse, it is $27 million plus. But again, this is going down from the year 2026. So what should we do? We should do a plan proactively. So let's look into this. So when do you want to do a plan? You need to understand, when you want to do the plan, you have to answer 4 questions. Number 1, how much money do you want to pass on to your next generation? And who should inherit your assets? Do you want to pass on the assets to your kids, to your brother, to your mother, to your parents, or to your friends, or to a non-profit organization, or to a charitable association? And how should they inherit them? Come on, yes, you built all your wealth, and how the next generation or the beneficiary will get the asset. You need to decide that now. And how should the transfer of asset? You need to have answers for these 4 questions. When you write your will and trust, you need to answer all these questions. And you may be thinking, Anil, do we really need this estate planning? I'm only talking about from the finance perspective. I want to talk about some basics about estate planning again here. So whatever money you make, as I said, after exemption, you will be paying 40% in taxes on top of the federal, and few states have estate taxes against state estate tax and also inheritance tax. So this is a simple snapshot of what state charges. Like example, if you're living in Washington state, there is an estate tax. If you're living in New Jersey, there is a state and estate taxes together. And if you're living in New York, there is an estate tax and state specific. So I'm not covering all these details. What is the percentage of taxes you need to pay at the state level? Because this is much more complex. I want to make this session as so simple and we are trying to cover the basics in the first session. And I want to cover here what could be the some of the options you have now. This is only our first session. We will continue to have a lot more sessions like this to bring the knowledge. And now, as I just said, you need to pay a lot of taxes in millions of dollars in taxes as estate taxes. One of the option to save these taxes or to optimize this is premium financing. This is where I would like to invite my guest, my partner here, Sudhir Pai, who is the CEO of MyTime Equity. So, and he's running a big platform of offering different types of services. And AZ FinTax and is associated with MyTime Equity now. And we would like to offer many more services to our clients so that it could be a one-stop solution. If we can for you anything about the finance, we want to get one-stop solution. That is why we are inviting my business partner, Sudhir Pai here. Hi, Sudhir.
Hi, Anil. Thank you very much. Wonderful presentation so far.
Yeah, thank you.
So thanks, Anil, and thanks for giving us this opportunity, to share what we do with your investors, clients, friends, So I would like to very quickly give a brief about myself. I am a chartered accountant, CPA like Anil, and I had started a couple of firms in the past. A few of them, which most of you might know, but right now I'm focusing on wealth management. And we have multiple companies under our belt. And the reason because this business is extremely compliance focused, very regulated. So because of that, we have multiple companies under the offering. So the first one is MyTime Equity and Legacy Wealth and Surely Now. These are the three companies. Each one of the company has its own leader. And the reason why we have separate companies, as I said, it's compliance. And second, we want the leader to take ownership of that particular service because each one of these is itself a big, scope of work to be delivered to our clients. So, we do, equity management under MyTime Equity, and we do alternative investments such as real estate investments and other private placements under Legacy Wealth. And last but not the least, we do life insurance and annuities, premium financing, IRA conversion under Surely Now. We also do, offer land banking as well as other real estate investments. And we had initiated a India Tech Fund under Alphatron. And my partners, very well-known personality, Suresh Vaswani. He used to be the CEO of Wipro and president of Dell. So he runs the India Fund for the technology on the technology side, which is currently closed. And we plan to open that sometime in 2025. Next slide, Anil. Yeah, so this is our team, and the team is pretty big. It's not just me or Sharath, my partner, who is also on the call. Sorry, I missed to introduce, investor relationships as well as sponsor relationships, and him and I started the business, in the very beginning in 2019. So next slide, Anil. Okay, so these are the 5 pillars of wealth management. Where do we park our money? As Anil said, first thing is save taxes because that happens to be the biggest expense out of your income. So save taxes first, focus on that. And you have got the best tax professional here with you, which is Anil Grandi and his team. So, I would not like to talk about more of tax here, but focus more on estate planning because that's the subject of today. And, we also help with real estate business ventures, insurance and annuities. Next, Anil.
You can control the screen, Sudhir.
Oh, is it? Okay.
Yes.
Okay. Okay, so about MyTime Equity, we manage close to about $100 million in the equity markets, and we have multiple equity models. This information, what you see on the screen, is available online on mytimeequities.com/portfolios. So we have individual stock model, which are into technology and all weather. Our portfolios have done extremely well compared to, the public markets. So, give it a shot, take a look at it. The fees and all are very transparently disclosed here. Now, what's the differentiation between us and a lot of others, right? That's the first question that comes. Now, the difference is we're actively managing the money. We just don't invest and leave it to God. We look at it. We try to time it a little bit. We see, that we focus on fundamentals as well as technicals, and on the macroeconomics that's going on. As we know, the Fed cut the rate of interest by 50 basis point, and that should boost the small cap, mid caps, financials, industrials sectors of S&P 500. Technology may stall a little bit, but we don't see it stalling big time. But we may see a short-term stalling of technology, and where all the value companies, which are 493 companies out of 500 companies, S&P 500 companies, will kind of take off, hopefully in the next 4 months before the end of the year. Next, Anil.
So you can manage it. Do you want me to manage? I can manage. Otherwise, you can manage it. Sudhir, I think your system, you are frozen.
Sudhir, we are not able to hear you if you're talking.
No, I'm okay. I was not able to control the
No
screen.
problem. I can control it then. Just you say like this or something, then I'll manage it.
Sure. Thank you, Anil. This particular slide talks about a structured note. Now, what is a structured note? A structured note is where we work with one of the top banks like Goldman Sachs or JP Morgan, and we try to get you a guaranteed return on your money, right? Instead of putting all money in the equity markets, which are very volatile, we buy notes. For example, if we buy a structured note on SPY, which is the S&P 500, or if we want to buy it on NASDAQ or Russell or semiconductor gold bonds, we can buy these with a complete downside protection and with an upside cap. So what you see here are very general terms of these indexes. For example, S&P 500 on a 2-year note, we can get a 13% return. And now the reason why this is preferred, because a lot of people don't feel good when they see the volatile market. They want peace of mind. They want an instrument which does not go down in value, and they are okay with the cap on the upside. There are insurance companies which sell insurance products with these kind of features, but I am here to tell you that we don't need to buy life insurance to invest in those kind of investments, because life insurance typically grows between 6 and 7% per year, whereas on a long-term basis. Whereas if you look at the structured note, you can generate anywhere from 10 to 20% return per year. Next, Anil. Okay, so this is one of the structured notes that we have right now, and the date by which a decision has to be made is by September 25th, because the investment has to be placed by September 27th. So if you look at this closely, there is a lot of English here. So let me make it very simple. We are buying this Goldman Sachs note. So it's guaranteed by Goldman Sachs. And I can use the word guarantee here because it's an assured guaranteed note. Otherwise we financial professionals are not supposed to use the word guaranteed. So I'm not saying it just for the sake of saying this is a guaranteed note, provided the terms of these notes are met. So the way it works is it's a 3-year note, and the bank can call it, meaning the bank can return your money in 1 year. Beyond that, they cannot. So the way it works, it is the underlying asset, meaning the stocks that are bought under this note, they are Meta, which is Facebook, Netflix, and Google. So these 3 stocks are bought, and it's a 3-year note. So the way it works is today we buy it, say it is September 27th. At the end of September 26th, 2025, if these 3 stocks are up even by $1 or the same price, you get 33% return. Now, let's say it is not all stocks are not up, but one of the stock is down or all stocks are down. It goes to year number 2, and year number 2 anniversary, 26 September 2026. If all the stocks are positive or even flat, you get 67% return. If that is not true, it goes to the 3rd year. And the way it works in the end of the 3rd year, if these are all flat or positive, it gets you 100% return. Which means if you put 100K, you make 200K at the end of 3rd year. In the 1st year, you make 133K. Now, what's the downside? Now, the downside is if all of these stocks have not fallen below 50%, you don't lose a single dollar. So that means these 3 companies, which are part of S&P 500, should lose 50%. If it loses 50%, let's say, Google is down by 60%, then you get only 40% back. So that's the risk. But if you are a believer that any one of these companies will fall below 50%, this is not the right instrument for you. And if you have a real conviction why any one of these stocks could fall 50%, then please call me. I would also like to know. So we all are believers of these three stocks because it is in S&P 500 and a lot of other ETFs in which our 401k money goes and things like that. So I don't believe that we are taking considerable amount of risk, but the amount of return that we are getting is like 33% per year. So if there is interest in this is a good one, but it's time sensitive. Next, Anil. Okay, coming to the main topic of the day, estate planning. And thanks, Anil, for giving me an opportunity to share those other information because it's time and sensitive. I thought we should talk to your clients about that. Now, coming to estate planning is very, very important, as Anil mentioned, because first, you want to keep the money. Second, you want to leave the money to your family. Third, you want to protect all your money against liabilities such as creditor lawsuits, business lawsuits, to try to put as much money into trusts and things like that. And why do you need a will? As Anil said, you need to have a probate. You don't want your or not in a condition to take decisions. You are medically not fit to take decisions. Those are the times when these documents come into picture. So a lot of people, when you talk to them about these estate planning or will and trust or probate planning, usual feedback is, oh, I don't need all that. I am very young. I may not, I don't think, I need this. I have enough coverage in India. I have enough coverage from my job. Now, keep in mind one thing, your life insurance that you get from your job goes away with the job. So you need something permanent, which should stay with you, even if you quit your job. That's number one. Number two, term life insurance is great if you are okay getting covered for 10, 20, or 30 years. But usually term insurance does not cover beyond 30 years. Now, why am I talking about life insurance? Because as I said, life insurance as an investment gives you between 5 and 7% return, not more than that. Long-term basis, right? And there are years where you don't make any return because if S&P is down or if the indexes are down, markets are down, you don't make any return. But why are they important? Because they protect you, they protect your life. And why are we talking about this with respect to estate planning? Because along with your documents such as wills and trusts and other medical directives, you also need a life insurance because they protect your life so that the family doesn't have to liquidate assets. And two, if there is a situation where you have to pay estate tax, which is if you have a net worth of more than $22 million, this life insurance comes into picture. Okay, next, Anil. So Anil did cover this to an extent. Let me just add a few things here, which is basically, you have a exemption of about $27 million for 2024. Now, this exemption depends on the Congress. Now, Biden today or whoever comes next can always change that to make it lower. Now, after Obama left, his position, they wanted to bring it down to $5 million per person in the household. So between husband and wife, the maximum amount that you had as an exemption for paying estate tax was $10 million, if that is reduced. So one should not think, oh, I am not worth $27 million, so this is not for me. Now, one thing I'll tell you, what happens to all of us coming in as immigrants in this country, we all work very hard, and that working hard and smart makes us successful. And most of you here who are representing the Telugu community or the IT serve community or the Indian immigrants living in the US, you will see yourself, if you compare yourself to the past, you will come a long way. Right now, what we are talking about is not a short-term plan. This is not like investing in land or real estate or stocks. This is a long-term plan. You buy life insurance not because you'll die tomorrow. You buy life insurance because if you die someday, because everybody has to die, that money can be used to protect the family and to pay your estate taxes. Now, what happens when you die if the estate taxes is 10 million and your overall net worth is 20 million? you end up paying 40% on that additional $10 million, which means you have to pay $4 million to the IRS. The question is, do you want to do that? And also go through the headaches of liquidating all your assets, right? Let's say you have your assets in land or buildings or stocks. Stocks is totally liquid, so no problem there. But when you sell to pay that tax, when your family sells to pay that tax, what if markets are down? Stock markets are down. What if the land is not saleable? What if the properties are down? Right? We don't want to give such kind of a trouble to the family, because first of all, the main bread earner is gone, and on top of it, the second household member may not know a lot of financial matters. Third, you don't want to put them under stress of execution on liquidation of properties and things like that, right? So here the goal is, you buy life insurance, put it in a life insurance trust, because it doesn't get added to your net worth. And when the main assured passes away, the money is there to pay the estate tax. Okay, so that is where life insurance comes in. Now, how do we buy life insurance, right? Because life insurance that we are talking about is not small life insurance policies. This is not like term life insurance policy. This is not like something very small. We are talking about buying a permanent life insurance policy, because nobody knows when they'll die. Are you going to die at 80, 90, 100, 110? Life insurance companies lets you buy policies, permanent life insurance policies till 110. So most of them may not live till 110. That means this is a permanent life insurance, which means the money that you put is not gone anywhere. And the other benefit of life insurance is it's totally protected. Nobody can touch it. Only IRS can take it if you default on your taxes. But otherwise, nobody can touch your life insurance plan. Nobody can touch your retirement plans. Nobody can touch your primary home. Nobody can touch your single car, first car. Okay, these are all covered assets. So that's why we try to cover as much assets as possible by putting it into multiple investments through IRAs, Roth IRAs, 401k plans, defined benefit and all, and life insurance. Now, keep in mind, life insurance comes with a cost, right? Now, you have to be careful on how you buy, what you buy.
It seems Sudhir has some internet issue.
Okay, can you hear me, Neil? Okay, so similarly, we can use leverage here to buy life insurance policies, and that we will cover in the next few slides. Yeah, Neil, next. Okay, I covered how life insurance works, term life, index, universal life, permanent. We talked about all that. Next. We talked about life insurance, but we did not talk about what covers besides death, right? So most of the life insurance policies these days, whether you buy term life or whole life or permanent life, it covers terminal illness. Let's say somebody gets hit with cancer. You can take almost the entire death benefit plus growth out of the policy to treat yourself from the terminal illness or chronic illness or critical illness or injury. So those days are gone where the life insurance money was only available to the family after death. So there are situations now where there are illnesses which needs a lot of money from a medical expense point of view. So you can use your life insurance for that too. So for those who don't know about it, this is an additional piece of information. Next, Anit. Now, how do we do premium finance? The reason why we do premium finance, I already discussed that. How do we do it? I already kind of touched on it. Here is a visual representation on how we do it. So there is the insured, which is you. You will be taking a loan, which is the lender, and your money and the bank's money all goes into a trust. And from that trust, we buy the life insurance policy so that your life insurance policy is protected. Nobody can touch it. And two, at the time of death, it doesn't get added to your estate. That means you don't end up paying estate taxes on it. Okay.
Sudhir, just I would like to add a couple of points here just to
Yes.
get more clarity to the people. So in simple summary, premium financing is like you don't pay premiums, annual premiums from your pocket. You are getting a lender who can give the loan to you based on your net worth and other parameters. So the lender will pay the premium for you. You will only pay only interest on that element, but remaining everything is lender will take care. Whatever premium you define. For first, how it works is at high level, see what is your net worth, how much estate taxes you need to pay. The estate taxes, whatever you need to pay, I mean, your next generation has to pay. Instead of they are paying from their pocket or by selling some assets, they can have a replacement or they can have this insurance proceeds, which is under premium financing. This premium financing is not a replacement for your regular term insurance or anything. This is only if this we want to recommend as a part of the estate planning. So they can get the next generation or legal heirs will get the money at the insurance proceeds. That proceeds they use to take care of the estate tax payments or inheritance tax payments at the federal level or the state level. So we will have a trust. Under the trust, the lender will get this insurance policy. So and the lender will give the loan also to this trust only. And but we need to, as an individual, as a main person, insured person, we may need to take care of the interest payments on the loan, whatever they are giving. So yeah, this is just I'm adding on to get a bit more clarity on this concept.
Yeah, thanks, Anil. And exactly. So, this is not a replacement, and this has to be done properly. And this is not right for everyone.
Yes.
This is good for those who have a concern of not having enough money for retirement, growing too fast and not having to pay estate tax, or 3, who believes in putting a lot of money in life insurance. For those who have other options of investing, this may not be the only option to invest and earn money, but life insurance certainly is a line item in your financial plan. Now, how do we buy the life insurance is what is premium finance. Okay, the sourcing of the life insurance policy, because we are all smart people, right? We know taking money from the bank is the cheapest, but it gives you headache. It lets you think all the time that you have to work hard. But if you don't have a loan, you are easygoing, right? But at the same time, you are also leaving some money on the table. Risk versus reward. So this is good for those who are business owners, who have a net worth of 2 to 50 million, 100 million, whatever. 2 happens to be the minimum. We usually say 5 on our presentations because we don't want people to take this and then worry. It's like buying let's say I can afford a $500,000 house, but my wife wants, or my family wants, a $5 million house. The question is, can I buy it? Yeah, I can buy it. But the question is, do I want to buy it? If I am willing to work harder to pay that interest, if I am not going to get worried when something happens to my income that I have to pay so much of interest, or if I know that, okay, this may take different level in life, right? Why?
Yeah, again, Sudhir.
Buy plus. But for smaller clients also we can buy. Don't get me wrong. We can buy. But the point here is this is an investment which has a cost because you are taking a loan. Okay. So please keep this in mind. Most of the insurance people don't tell you all this. The reason why Anil has chosen us to be here in front of you is number 1, because of our transparency and because we explain the risks first and costs first before we talk about the rewards. And we are known for this in the market, for being very honest. Next, Anil. Okay, so here is a quick illustration of how this works. And what we are doing here is, we are putting, $50,000 for 12 years. And we are getting a life insurance policy of $5.4 million of initial death benefit. That means you buy it today, die tomorrow, you will get $5.4 million. Okay, that's the initial death benefit. Death benefit at the age of 70 is 3.19 million. And at the age of 70, how much income can you earn? We are all looking for retirement income, right? That is one of the reasons why you buy life insurance as well, to generate cash flow when you cannot generate cash on your own, right? So the income that you will make potentially at age 70 to age 100 is around $285,000. And how much are you contributing for 12 years? At $50,000 for 12 years, the box on the left-hand side, you are contributing about $600,000. And how much total tax benefit are you receiving because of all this is close to about $16 million. Now the numbers look so big, right? It looks so good to be true. But it is true if you are patient by investing $50,000 per year and letting the policy do its job for 30 plus years. 30 years is a long time. Why do you buy a home which has a 30-year mortgage on it? Because 30 years solve all problems. Why are you celebrating your 25th anniversary with your wife? Because that means you have solved a lot of problems, right? So 25, 30 has some relevance in life. And that is why life insurance policies should be looked upon from a 30-year point of view, not from a 3-year point of view or a 10-year point of view. If your focus is 3 years or 10 years and that short-term focus, then you should simply buy term life. You are not the right candidate for this. Okay, so very, very clear. So, this is a complex illustration. It has a lot of numbers. It will take me usually about 4 to 5 meetings for people to even understand these numbers, right? Because each one of these column is complex. So if somebody comes to you and says, buy whole life, buy IUL, don't say fall for it, because all this insurance is a very complex thing. You should know what you're signing up for. Very in short, what I'll tell you is here we are paying in column number 3, which is new premium loan. We are going for a loan of about $400,000 from the bank, and we get to pay that for 7 years, meaning the bank is paying a loan, we stand guarantee to it, and the bank is paying $400,000 a year. And column out of pocket, which you see, a sixth column, $50,000. That is what you are paying from your pocket. Okay, so you are paying, a smaller amount than what the bank is putting in. Now, why will bank give you money? You may think, oh, on a house I am buying, they are giving me because it's a house. Why will bank lend me on a life insurance policy? The bank will lend you on a life insurance policy because in the initial few years, the surrender value is low. Why? Because the insurance companies don't want you to cancel policies after buying it. They want you to mentally be prepared that this is a long-term commitment. It is like buying a house. You can't buy a house today and sell tomorrow or in 2 years, because the brokerage commission on it, the closing cost on it, all of that eats up a lot of costs. So you will move away from a rental property, term life, to a permanent policy, which is, your own home, only if you think you are going to stay in that house, life insurance, premium finance, for a long period of time. Otherwise, this is not right for you. I keep saying this because it's very important for me to tell what is right for you, because end of the day, you have to buy what is right for you. So, you are going to take this big loan and you are going to put a small amount of money, and all of this money is in the policy growing because we invest this money in S&P 500 type of index, which generates between 8 and 10%. Okay, but for this calculation, we don't take 8 to 10% because that's aggressive. We take around 6% because, as I said, long-term basis, insurance policy grows between 5 and 7%. It could be up to 8, but we are usually conservative, right? When we are committing to certain amount, we are usually conservative. If I am being aggressive, then it's very hard for my client to figure out what is right. So I have to be super conservative. So this policy gives you $5 million plus, and at the 16th year, we pay off that loan because the money is growing. We pay off that $4.2 million loan, but we still have about $1.1 million left in the policy, which is surrender value. Okay. After paying off the loan, if the policy is growing by around 6%, after paying the interest on the bank loan, the policy still has $1.1 million loan. And at age 70, because now it has $1.9 million available in the bank, in the policy, you end up taking $285,000 per year as your retirement income. So this is the beautiful structure. It is like buying a home and renting it out. So same as that, but it's a long-term policy because you are investing in equity markets, and equity markets take time because it goes up and down. Yeah, Anil, you want to say something?
Yeah. So just adding to some more to what Sudhir says. So in simple, you get bigger coverages, bigger retirement incomes like annual, like an annuity. Every year you are getting some money, standard money to manage your family, or even something happens to you, you need your next generation should get a bigger money. How do you achieve all those things? By paying money or by investing money from your own pocket. Technically, you need to do all these premium payments from your pocket, the around $4 million plus what you can see here. But here you already built net worth. You are taking a loan to pay your premium. It's called leveraging. If you have attended, many of my real estate specific strategies or tax planning webinars, I clearly say that you already built your wealth. You need to leverage. You need to leverage it. So, like lender is giving the loan, lender is paying the premiums on behalf of us, and we are only paying some money from our pocket so that it will not be a heavy big burden for us. See, rather than paying $400,000 premium, I am only paying around $50,000 premium every year. And so that my initial investment from my pocket is low, but I'm getting a bigger coverage. The bigger coverage will help in getting a, see here, you get a net worth, big death benefits. If something happens, we don't know when it will happen. If something happens, we get a bigger coverages. And if you are happy, if we are alive, we'll get an annual annuity premiums. Like every year you get some standard recurring income after you retire. Or if something happens to like critical illness, all those things which are already covered, Sudhir covered, if terminal illness, critical illness, if you are impacted with a higher, bigger problems, that is, you are living, but you cannot do anything. So, or you are about to die, when you can even get some money when you are alive also. So these are the advantages. Those are the programs which are available, which can be worked out for high net worth individuals only. This is not for people. This is not for everyone. Premium financing is only for high net worth individuals. As Sudhir Pai said, it's minimum of $2 million, but generally it is 5 million and above is yes. But for $2 million also we can do some customization. $2 million of net worth. If you're less than $2 million of net worth, this is not your right this may not be the right for you. As I said, this is one of the program which we are talking today as part of the estate planning. There are many more other options are there which we are going to cover up in our future webinars. But considering the time, we are only focusing on one topic today. Yeah, Sudhir, yes, yeah, go ahead.
Yeah, next slide, Anil. Next slide. So as I said, you covered this, Anil, so we can go to the next. This particular plan which we showed you, the premium finance of $5 million plus net worth, that is good because you can take a much bigger policy. Now, for those who like the idea of taking a loan from the bank and buying a life insurance policy, we have a smaller plan where we call it Rothish. We have a smaller plan. In this, what happens? The bank gives you a loan from year 6 onwards. So the first 5 years, you put your own money, and the rest of the years, the bank comes in. Because, a lot of us always want to feel, let's go one step at a time, right? At least I am like that. Let me not take a big loan. Let me go one step at a time. So first 5 years, let me put my own money. Then we will take back.
So this is like a hybrid model. So you pay from your pocket initially, you build the cash value of the policy. After that, you get banker loan. You already have the loan. You already have the contributions. Yeah, Sudhir, as you are on frozen.
Oh, okay. It got frozen. Okay, yeah, if you can go to the next slide, please. Okay, so if you look at this slide, here what is happening? We are buying a life insurance policy for about $2 million of death benefit, the rightmost column, and we are putting $50,000, same as the other plan, but you are getting half the death benefit here, right? Because the structure is different. We are putting $50,000 for 5 years, which means we have put out $250,000. For the balance of the money, the bank is now contributing from year 5 to year 10. Okay, so the bank has put money, you have put money. If you come to the right side, the loan column, now you have a loan which needs to be repaid in year 11. So we pay off that loan in year 11 of $1.2 million. And that allows us to take an income of $139,000, from age 66. Okay, so this is a good plan for those who want to give it a start, want to take advantage of the loan, also have life insurance to protect you and your family and estate tax, but still, not taking way too much responsibility on our shoulder to pay a lot of interest, right? So this plan is created purely for members of our community who have just started, or who have grown really big but want to start small. So, and also for immigrant community, we can do this for H1 visas, L1 visas. We can do this for people living in India. So, there are those opportunities here as well. Next, Anil.
Just adding to this, as premium financing is the first model. What we discussed is for the completely banker loan from the beginning, and the second option is like Ratish. It means you pay from your pocket initially, after that get the loan. If both the concepts, if you understand, the year 11 banker, from the policy itself, we will repay the loan. You are not paying money, or you are not repaying the money to the loan from your pocket. We are building the wealth under the policy, and after 11 years, after 10 years, the policy gets accumulated, the policy gets grown. From that policy itself, we are repaying the loan. So you are not paying from your pocket. And after that, the money, whatever is left over in the policy, that will continue to grow every year, year on year. And you can manage these funds on a year on year basis. You can choose how do you invest, where do you want to invest, whether you want to take a higher risk, medium risk. All those things also can be chosen at your interest. And after that, after a few years, let it grow for a few more years. Then let's start enjoying the benefits of retirement benefits, like annuity benefits after your retirement for lifelong. So
Yeah. Thanks, Anil. So, how do we buy life insurance? One is premium finance. Now, within premium finance can be also implemented within certain retirement plans for business owners, particularly. If you have a defined benefit plan, and I'm sure you are aware of a defined benefit plan is a mega retirement plan. In this, you can put anywhere from $200,000 to $700,000 per husband, and for wife, the similar kind of amount. So the contribution can be very big, unlike a 401k plan, which lets you put only about $19,000. So once we have a defined benefit plan, which means you are writing off that 500, 600K from your business income, that sits in the retirement plan. And from there, we can do the premium finance as well. So that's the beauty of, defined benefit plan combined with, a premium finance or a Rothish plan.
we recommend defined benefit plan, not for everyone. Defined benefit if you are an individual high earn income, where you don't have big employees, or otherwise, if you're like example, you are running a hospital, you are a physician, and you have some nurses working for you. In those cases, yes, it can be done. But if you're running an IT company with maybe 20, 50, 100 employees, defined benefit plans are not for you. Or otherwise, if you're working on a 1099 contract where you are making a lot of money, but you don't have any employees under you, then again also we recommend defined benefit plan. Under defined benefit plan, as Sudhir said, the contribution limits can be more than $200,000 for you. And if your spouse is also working for the same company, then she can also contribute. So that's why you can build your defined benefit plan. Under defined benefit plan also, you can get this premium financing and all other options also we can be worked out.
Yeah. Thanks, Anil. And to add to one point there, IT consulting companies, which you touched on, which has employees.
Yes.
Now, if the IT consulting owner is a owner who wants to give away a small amount of money to all the employees with some kind of a vesting plan, like a stock option plan, you basically say we'll pay all our employees a little bit of money, because defined benefit plan can be discriminated. You can pay more to the owners and less to the employees, unlike a 401k plan, which cannot be discriminated. So this works well if the employers want to pay a little bit of contribution to employees, but they want to put a restriction on how they vest. You can put a 1-year vesting, 2-year vesting, 3-year, 4-year, 5-year vesting, which means if the employee remains in the company for 5 years, then only they get that 100%. So we can create those kind of defined benefit plans also. But if you are
Yeah, defined benefit plan. Yeah. Again, Sudhir. Sorry, guys. I think Sudhir has some issue with the internet.
Sudhir, your screen is freezed.
Yeah. He can't hear you.
Uh,
The internet can't.
Hello?
Yes.
Yeah, sorry.
No problem. Yeah. Go ahead, Sudhir.
Sorry, I think it's my internet.
No problem.
Yeah.
Go ahead.
Yeah. So what I was saying is, defined benefit plan works well for certain types of business owners also if you have employees. So, talk to Anil and we can always see how, we can accommodate a defined benefit plan for you. Now, coming to how do we do the process of estate planning? First we'll have to sit and talk and understand what are your goals, what are your potential estate tax liability, what is your interest in protecting your assets, how much of taxes do you want to save, and all that full-blown understanding of your situation. And then we can come up with the plan. Whether premium finance is good for you, Ratish is good for you, term life insurance is good for you, or no insurance is good for you. So all that plan we can come up with and execute it for you. Usually it takes around 3 to 6 months to do this. We'll have to bring an estate attorney in, which means a lawyer. We are not lawyers. Anil and I both are not lawyers, but we have a network of lawyers. We bring them in, make it a teamwork, and kind of implement the right thing for you. That's our process. Yeah, Anil.
One second. Sorry.
Yeah. So reach out to Anil, if you need any help from us. We work with Anil because, Anil knows how to evaluate, educate, as well as understand what the client needs. Because when Anil says this client wants defined benefit plan, it becomes easy for us just execute because he has done a lot of groundwork and, he knows clients in and out. He meets their families. So please reach out to Anil if you need any help. Our information is here, but if you contact us, just let us know that you are part of Anil Gandhi's team or clientele, so that we know that to give you that preferential treatment. Sharath here is here. Sharath is exclusively taking care of all Anil's clients, and so you will get a CPA and a wealth advisor and somebody who is always there for you to take care of your needs.
Thank you. And I did also share my calendar link if you want to discuss more or if you want to do an initial evaluation. So you can schedule a 20-minute schedule a call with me. I just shared my link in the chat box. And also you can also see on every screen I have this one-on-one meeting you can schedule with me. That is also if I can do initial evaluation, then I can connect with Sharath and other team members appropriately. And before just getting into the Q&A, just from the AZPIN tax, this is we would like to talk about tax planning. This is the right time for you to think about proactive tax planning. Throughout the year, we earn money, but at the end of the year, what we do when we file taxes, for every dollar we earn, we are paying 30, 40, 50% in taxes. But if you have a proper planning, proactive tax planning, it can be saved further. So I would love to have one-on-one meeting with you guys to design a proactive and strategic tax planning, which is relevant for your business, personal. You may be having multiple businesses. We can review the overall your business structures and come up with an advanced tax planning. And when we do the tax planning, we just don't do a tax planning like we are not like regular accountant or CPA who just type the numbers whatever a client wants. No, we are a planners where we can customize the tax plan based on, we look into the different parameters, your retirement tax planning, deductions, tax deductions, entity structuring, insurance, loopholes, and any industry specific strategies. We spend a couple of weeks working with you, analyzing your previous year tax returns, understanding your future plans, identifying the right relevant strategies for you, then come up with the tax planning. What is the best time to do the tax planning? Now we are already late for this year. For the year 2024, let's start working on tax planning one-on-one. You can schedule a meeting with me. You already see the link with me. You can schedule a meeting with me. Let's talk, because after December 31st, there is nothing much you can do rather than just paying the taxes. How do you save tax? Let's have one-on-one call. It's a free call for the business owners. You can schedule a meeting with me. Let's discuss if you're relevant, if you're a right person, right client for the tax planning, then definitely I would love to do work with you on designing a customized tax plan for your scenario. So, and that's it. And I will take up the questions. Thank you very much. So Sudhir, there are few questions. Sharath, can you help on questions and Sudhir can answer?
Yeah, I can see it.
Yes. Okay.
So the questions are, what are the returns for clients, who have invested in, I think it was about structured notes or maybe investments. So the existing returns are there in the website. It's been pretty decent and better than S&P 500. And, for the structured note, the historical returns depends on which structure, right? So most of the structures go as per the contract. So there is no deviation from the contract. And given that it is from one of the top banks, the experience has been great. Depends on income note or growth note. So we can discuss that with you, depending on which structure we are talking about. And coming to defined benefit plan, there is a question on defined benefit plan. What are the downside? So the downside of defined benefit plan is you have to have it at least for 3 years. You cannot open a plan and then close it in less than 3 years. Second, it costs to set up a defined benefit plan. It costs anywhere from $3,000 to $5,000 depending on the size of the plan. And the third is you should be willing to put so much money in the fund, which means your business has to be doing extremely well to set up a defined benefit plan. And if you have employees, 1099s are fine, but if you have employees, then you may have to contribute for them as well. So those are the downsides of a defined benefit plan. And can you guys clearly explain who should do premium financing and who should not? So yeah, so premium financing is good for those who have a concern of having to pay estate taxes at death, or to who want a very high retirement income at retirement age, or three, who want to use leverage and buy a bigger life insurance policy, and they have enough credit worthiness to buy the policy. The way I look at it is buying life insurance through premium finance is like buying a bigger house than what we need, or having a need for a bigger house, right? So I look at it that way. Yeah, so and looks like my going in and out of the webinar because of my internet connection has troubled few people. So sorry about that. Next time I'll make sure that I sit in a different place and have these kind of sessions. Yeah, I think that's the only
There is
question.
one question. Yeah, there is one more question. My estate is less than 5 million. Can you just answer that question also?
Yeah. My estate is less than 5 million. As per your explanation, I do not incur estate tax as long as. Yeah, so if your estate is less than 5 million at the time of death, it is not today. So if your estate is less than the estate tax limit on the day of your death, then you don't have to pay estate tax. So as of today, the limit is big. So we don't know when we die. So you end up planning it, because planning is better than not planning. So the answer to your question is very simple. So you don't have an estate tax liability as of today, but what we are doing here is planning.
And there is one more question, Sudhir. Can you guys explain clearly who should do the premium financing and should not? Explain downsides of the premium financing.
Yeah, so those who should do premium financing are those who have a need for it, number one, which means you have a need for estate tax planning. Two is you want higher retirement income by taking leverage from the bank. Or three, if you're a believer of life insurance policy and you want a bigger death benefit. In those three situations, having a premium financing plan is a good idea here. And then there is one more question that is showing up here. Can we do defined benefit plan for your company if you have W2 income and 401k from employer? Yes. So the way we structure the defined benefit plan is a combined plan. So we have 401k, which is pre-tax. Then we have defined benefit plan, which is pre-tax. Then we have after-tax Roth 401k as well. So we look at all three buckets and create one big plan, and we implement it for businesses. That's it, right, Anil?
Yeah, there is one more question from Varun.
Is business
possible-
also an asset? Will incur state tax when it is sold? When main person is business, what I'm not able to incur
His
state
business
tax.
is also an asset and will incur state taxes when it is sold when the main person is not alive.
Yeah. So the question is business part of your estate? So yeah, so anything that you own is part of your estate. Even a life insurance policy, not in a trust, but in your name. So that is where the whole trust planning comes, which Anil mentioned, right? So when you say will and trust, the idea is to put as much of assets inside the trust. Now again, the limit for putting the asset inside the trust is also the estate tax limit, which is $22 million. Now let's say you are $100 million net worth. You can't take all $100 million and put it in the trust. You can only put it till $22 million. That is where planning becomes right now, because there may be a situation if the government changes, if Harris wins, she may reduce the estate tax limit from $27 million to $10 million or $5 million. You don't know. So right now, if you do it, it is kind of grandfather. That means whatever you do today will apply for life. So estate planning includes wills, which is a simple document, trusts, which are a little complicated, so more discussion. Third, how do we finance the estate tax at the time of death is done through premium finance. So that is one bucket. Second is, I don't have estate tax problem, but I still want to buy life insurance because I believe in it, because I want a bigger retirement income. I want to leverage the lowest cost interest rate that yeah, can you hear me? Sorry about that again. Yeah, you're on mute, Anil.
Yes, yeah, we can hear you. Yeah.
So we can structure it that way.
Yeah, there is one question on from Chandan. Can we do defined benefit plan for your company if you also have W2 income and 401k from employer?
Yes, we can. There is no restriction on anything. So last question so far, the 27 million estate limit by IRS is expiring in 26. Will I get benefited by plugging in? Yes, you will get the benefit. That is where the planning comes, which Anil mentioned about.
Yes, correct. Yeah, you can before 25th of December, 2025th December, if you can transfer assets to your anything to the next generation, yes, these limits are applicable. The estate planning, the transfer of assets can be done either at the time of your dismissal, or you can do proper planning now itself. So if you can do the proper planning for before December 2025, you can go under this $27 million. Otherwise, from the January 2026 onwards, the limits will go down. It can be $5, $6, $7 million approximately is what we are thinking at this point. So, but so it's better to do the planning before December 2025. So that is why we are saying that come, let's do it. And Sudhir, you can add.
One more point to add is the global assets. So this includes India assets, land in Hyderabad, jewelry of wife, all of that. So, it's not just US assets. So it includes, way I think we should plan is put all the India assets in a trust, which is protected. And the India asset, you put it in a trust there, which Anil can help you by creating a trust in India. So both places you are protected.
That's it from my side. And if anyone, I think Ram Cherukuri has raised the hand. Ram, you can talk if you would like to ask any questions. Ram Cherukuri, you raise your hands. You can ask questions if you have. Okay. Okay, I removed his hand. Yeah. Okay, if anyone has any questions, feel free to send an email to me, or you might have the email, whatever you received now, you can reply to that email for the registration, whatever your email you received, or otherwise you can reach out to me. I hope you all have my contacts. Or you don't even need to remember any name. Just Google search my name. You will find everything about me, my contacts and everything. Okay. So about AG FinTax, there are maybe hundreds to thousands of pages are there, videos are there, articles are there, knowledge sharings are there. So very simple. Just Google search my name. If you remember, that's all you need to know. Everything will automatically follow you. And thank you very much. And Sudhir, thank you very much for accepting my request and sharing your knowledge to our community. I really appreciate. You are so knowledgeable, and I'm so happy to partner with My Time Equity in offering more services to my clients. So I'm so happy for it. Thank you very much, sir.
Thank you very much, Anil, for giving us this opportunity to work with your clients, partner with you, and support the community. Look forward to taking care of you and your clients. So do let us know if there is anything that we can help with.
Definitely.
Thank you, Anil. Thank you so much for the
Thank you.
opportunity.
Thank you.
Okay, bye.